I'm Taylor Briggs in San Francisco in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, streaming surge. Comcast debuts Peacock, its new streaming service. Can it stand out against others in the space? Plus, climate control. Microsoft makes a major push into removing carbon from the Earth's atmosphere. We'll get details from Microsoft President and Chief Legal Officer Brad Smith. And keep pedaling. We'll talk to an analyst who thinks Peloton is not just a fad. That bullish sentiment coming up. But first, we begin with the continued dominance of tech in the U.S. markets. Bloomberg's Abigail Doolittle joining me from New York. Abigail, I have to admit, the stocks up 1.7%, NASDAQ up more than 1%. Is this a relief rally from phase one of the trade deal or something bigger going on?
You know, Taylor, it certainly feels like 2019, especially the fourth quarter, this unstoppable rally just keeps going. It doesn't really feel like a relief rally, and I say that only because yesterday after the signing of that phase one trade deal, it was just the stocks that dropped more than 1%, tech down slightly. The other major averages actually posted record highs, not the NASDAQ, but the S&P 500 and the Dow. So typically a relief rally would come after a big sell-off for all of the major averages. It actually feels a little bit more like perhaps the early stages of euphoria within the bubble paradigm. That starts off with basically capitulation and dislocation, then into the boom or the economic phase, and then into euphoria. That goes into profit taking and then into panic. Put another way, really extreme FOMO. But does that match the fundamentals? When we take a look at the stocks from a PE standpoint, trading at a greater than 20 times forward PE, even though, Taylor, last year, as you know, earnings fell by double digits. They're expected to fall for the fourth quarter to be reported, the first quarter of 2020 as well. By the end of the year, analysts are looking for double digits growth for tech and for the chips in particular. But typically, especially for the chips, the first half of the year is difficult. So it seems like investors could just be a little bit ahead of themselves, Taylor.
Well, Abigail, speaking of getting ahead of ourselves, I want to come and show you a chart here that I'm showing inside my terminal. Another day, another new record high, another $1 trillion company, and that would be none other than Alphabet. As you can see in the bottom in blue, catching up now to the likes of Apple and Microsoft. What did Alphabet do to join that $1 trillion club?
You know, well, they have really been executing. And so for that reason, investors really rewarding those shares of Alphabet, putting them into that very elite status. You know, in terms of what it means, though, Taylor, you know, when you have the Dow hitting big psychological levels, does it actually mean something? Probably less so. So in this case, it really is truly an elite status. 3 companies in the world, really pointing to the dominance of tech and internet. But relative to Alphabet and moving forward, it doesn't mean managers are going to have to weight this stock more. Large cap and tech managers already overweighting probably this stock, and it probably doesn't help their fundamentals. But, you know, it's certainly a nice to have to say you have a $1 trillion market cap and that it has come on stellar performance and on large numbers. That's really pretty impressive.
Abigail, I want to talk about fundamentals and then also fold in some of the technicals of which you are superb at. Come and take a look at a chart here that we're showing inside the terminal. We are coming up on earnings when we look at fundamentals, but how the technicals sort of set us up for those earnings?
You know, Taylor, we are priced to perfection. That chart there in particular is really pretty amazing, scary even. What we're looking at on top is the S&P 500 Tech Index, and those blue boxes, those are areas where the index has been well above the 200-day moving average, telling you that investors are ahead of themselves, that they're extended. But you can see a period there in 2017 into 2018, that was not a problem. At that time, the RSI on bottom, a momentum indicator, well into overbought territory, close to an 85 and 86. Right now, though, Taylor, we are 18% above that 200-day moving average, far more than earlier. And the RSI only, and I say only because this is overbought, but only at a 77 relative to the 85. So beneath the surface, a little bit of a bearish divergence. The bull's not quite as strong. Price to perfection from a valuation standpoint and a technical standpoint. This earnings season really has got to be knocked right out of the park. Otherwise, we could see some pretty quick consolidation there.
Well, our thank you on all things markets with Bloomberg's Abigail Doolittle. And Comcast officially unveiled its entry into that crowded streaming universe. The service, dubbed Peacock, isn't launching until April for some subscribers, and while it will feature new original content, it's going to rely heavily on the hopes that viewers will continue to tune in and pony up for old favorites like The Office, Parks and Recreation, and Brooklyn Nine-Nine, among others. We also know that there will be 3 different pricing tiers ranging from free to $9.99 per month. To tell us more about how Peacock is going to fare against the likes of Netflix and Disney Plus, it is Wedbush analyst Michael Pachter and Bloomberg's Lucas Shaw. Lucas, let me start with you. How does Peacock here stand out in what is very crowded market?
Well, what Comcast has said and has kind of telegraphed as what makes it stand out is that it is free to a lot of people. So you see in the marketplace, Netflix costs $10 to $13 depending on your package. Apple service costs about $5. Disney Plus is $7. Hulu's anywhere from $6 to $10. The 2 that are coming up are HBO Max and Peacock, and they've taken sort of polar opposite ends of the spectrum. HBO Max is loading as much programming in there as possible and charging a pretty high price relative to the others, which is $15, whereas Peacock, for its most basic plan, is free. Now there is one package at $5 and there is another at $10, but you'll be able to access lots of different TV shows and movies at no cost, and they're framing it as sort of an advertising play, which is interesting because that puts Comcast not only in competition with the likes of Netflix and Hulu and Disney, but with Facebook and YouTube, which are the 2 biggest online advertisers in the world.
Michael, does the pricing strategy mean anything? It seems like a race to zero if they're all coming out around $4.99 or so.
See, I think Lucas is right. I think people are missing the point here. These guys are in this to protect their core business, and Comcast's core business is providing, cable service. They want that $85 cable bill, and they're going to do everything they can to protect that core business and give their core customer a reason not to cut the cord. Netflix only can survive if they can charge every single customer. HBO is already charging customers, so they're just enhancing their core business model by giving customers more for the same price. So, these guys are all approaching the streaming wars differently. And at the end of the day, I think the right solution is that all cable customers get all content on demand all the time. And I would pay $25 a month or $50 a month more to be able to watch I Love Lucy on my Comcast subscription. And, that's been the problem. It's the deals that are cut with the talent that creates the shows. You're only able to go back something like 5 weeks on broadcast television. And that's what opened the window for Netflix to get second window content. I think Comcast realized we can keep our own stuff, our NBC Universal stuff, and bundle it and give it away for free. Warner realized we can keep our own HBO content and bundle it for free. Amazon's just giving everything away anyway, and Netflix is the odd man out here who has to create content, and they're way behind the other guys because they don't have a first window to monetize that content. So again, I think Disney, Comcast, Warner Brothers all win. I think Netflix and Amazon lose. Fortunately, Amazon's got another side business that it can rely on to fund all this.
So, Lucas, come in here and react to some of those thoughts on content wars. It's really interesting to try to see how Netflix is trying to stand out with trying to do more Oscar nominations. You've Comcast now coming in with some more original programming, but also, like Disney, sort of a backlog of old material. In the content wars, where does Comcast sort of stand out for you?
Yeah, I think Michael is right in that this fits into Comcast's broader strategy, which is that streaming is never going to be the main business for Comcast. Comcast doesn't want streaming video over the internet, to be the dominant platform, if you will, because Comcast's interest is selling you cable and increasingly really selling you internet. It wants you to view Comcast and buy internet from Comcast, and it makes a really healthy margin on that. And so they will offer Peacock, even the paid version of Peacock, as free bundled into those people who either get cable from Comcast or just get Xfinity Flex, which is their internet service. So I think that makes Comcast sort of an odd player here because they are not going to compete at the same level of funding, programming, or marketing, I think, as some of these other players. And that leads me to believe that it won't be quite as successful. Now, it might be fine for Comcast Corporation. You know, Comcast is going to make a ton of money selling internet service, and it will for the foreseeable future. But I think they have to figure out how they want to position Peacock in the marketplace against Netflix, Amazon, Disney Plus. You know, Disney Plus has a very clear brand proposition with its programming. You know what you're signing up for. Same with Netflix. Netflix has a little bit of everything for everybody. I'm not sure what Comcast and Peacock in particular in this case represents to the average consumer, and they probably have to spend a lot of money to make it known.
So, Michael, finally to you, I wonder the capacity for all these different streaming services per person, per household?
You know, the average consumer or household spends something like $85 on cable. And as you can see from Netflix's numbers, add another $12.99 to that. So we're spending about $100 on video content. I think people are very comfortable spending $100, and I think that above median income households are fine going to 120 or 125, and they'll add as many services as they perceive a need to add. The interesting thing is that each of these services differentiates by having exclusive content, and that's not necessarily original. That could be old stuff like Friends. But they're all exclusive. So Disney's got old stuff like The Simpsons, and that makes it worthwhile for an old guy like me. I think people have the capacity to spend $100, $120 if they're above median income. I think they have the capacity to spend 30 or 40 if they're below median income. And that means that they will shave the cord or cut the cord if they really want this content. So I do see the streaming services proliferating. I don't think they're competing for subscribers for the first year or two. That's going to come when they start to saturate and people have 3 subscriptions and can't justify the 4th one.
Well, a never old Michael Pachter of Wedbush and Bloomberg's Lucas Shaw, thank you both for joining us. And coming up, Microsoft joins the global movement to fight climate change. We'll hear from President and Chief Legal Officer Brad Smith about plans the tech giant has in store. This is Bloomberg. Microsoft made a major investment announcement in the effort to fight climate change Wednesday. It will invest $1 billion in companies and organizations working on carbon-reducing technology. I spoke with Microsoft President and Chief Legal Officer Brad Smith earlier.
Microsoft's commitment today to put $1 billion into climate innovation is a piece of a broader plan. But the fund itself will really be focused on accelerating innovation and climate reduction and removal technology where money is not flowing already. So one area that we just see of being paramount importance is the creation of new and better technology that will enable us all to remove carbon from the atmosphere. Another area where we see a critical need for money where it's not yet flowing is, for example, project finance for renewable energy sites in, say, developing markets. There are some parts of the world, perhaps especially in the United States and in Western Europe, where capital is already flowing for new renewable energy, but not everywhere. And we want our money to make a difference.
So are you really looking outside the U.S. to deploy this $1 billion?
Certainly, in part, we're looking outside the United States. I would say, especially when it comes to the creation of new places that will generate renewable energy. But when it comes to technology innovation, it doesn't know boundaries. It doesn't know specific countries. I'm sure there will be some of this flowing inside the United States, across Europe, and perhaps around the world.
You know, as you take a look at some of Microsoft goals, I know that you have a plan by at least 2030 to be net carbon negative. Where are we on achieving that goal?
Well, I think in many ways, the most ambitious thing we're saying today is, as you just mentioned, we will be carbon negative as a company by 2030, not just for our company, but for our supply chain, for our so-called value chain. And by 2050, we will remove from the environment all of the carbon that Microsoft has emitted, either directly or for electrical consumption, since we were founded in the year 1975. that is a big goal. We have a detailed plan, but we have a lot of work to do. That's why we said this is a decade-long ambition for us.
You're working with a lot of your suppliers and your customers to make sure that they are doing their own initiatives in terms of being net carbon neutral as well. How are you folding in these goals with perhaps some of the contracts that you're making with suppliers and customers to make sure they're being held accountable as well?
It really does require a very detailed plan, which we've been putting together over the past months. One aspect when it comes to supply is naturally the supply of electricity for ourselves. And what we are saying today is that by the year 2025, we will have power purchase agreements in place for 100% renewable energy for all of our data centers, all of our buildings, and all of our campuses worldwide. But then there's all of the other emissions that are generated, for example, as part of our supply chain. And as you said, we will be implementing by next year new tools and processes for our suppliers. We'll want to see consistent measurement of their emissions. We want to help our suppliers with new tools so they can reduce their emissions. We will be talking with our suppliers in the coming months. I think you can expect to see us move forward with new economic incentives so that as we're buying goods and services, we're focused on encouraging our suppliers to reduce their emissions. And if they do, I think they're going to find it easier to sell their products to Microsoft.
That was Microsoft's Brad Smith. We'll hear from him again next on how Microsoft and other big tech could benefit from the U.S.-China Phase 1 trade deal. This is Bloomberg. More from Microsoft President Brad Smith. On the same day U.S. and China signed the Phase 1 trade deal, Smith spoke out about their long-lasting tensions. He told a Seattle conference Wednesday that divisions between the two largest economies risk creating a technology Cold War. I asked him to elaborate on his comment earlier.
I think it was indisputably a good and important step. It absolutely adds stability. It creates a foundation for additional progress. It adds to business confidence. So we were definitely very happy to see it and supportive of it. And I think we should all want to see continued progress made by the two governments together.
You were talking about a real threat of a technology Cold War. What does that look like to you? Well,
I think that a Phase 1 trade deal doesn't necessarily put to rest all of the other technology issues that have become part of the geopolitical landscape, if you will, between the United States and China. These are not just the two largest economies in the world, they're the two economies that have the strongest tech sectors. Both governments are very focused on the national security implications of technology products. Obviously, the 5G conversation has in part become a conversation around national security, about economic security. And I don't think that is going to change because of a Phase 1 trade deal. I think we should all expect this to be a complicated issue, an important issue, and one that's going to be very topical on an ongoing basis throughout this decade.
You only get about 2% of global sales from China, and I wonder if that's been perhaps more of a concerted effort to protect yourself until these issues are resolved. I'm thinking IP theft, forced tech transfer, all of those issues. So does this really perhaps change anything for Microsoft's fundamental business?
I think today, the United States government has concerns about certain aspects of Chinese information technology coming into the United States, and you see the same thing where the shoe's on the other foot in China, as it has long been. I don't really think that's going to change anytime soon. I just simply because of the connection that the governments in each country see between information technology and their national security. I think that means there's still very important opportunities for collaboration, and we should keep that in mind. There's a lot of basic research that happens in the digital technology space that's really global. There's the creation of software code, including by open source developers, that also genuinely takes place on a global basis, often involving people writing code in China and the United States, India, Europe, and ultimately bringing it all together. I think the world is going to need our two countries to work together even while we manage these tensions. And if you take something like sustainability, if you look at carbon, the two countries that have the biggest impact are China and the United States. We need to work together to solve some of the world's big problems for our own sake as countries and, frankly, for the world as a whole.
I want to move as well onto the JEDI Pentagon contract and then the subsequent Amazon lawsuit. They're effectively then saying that you didn't deserve it. How do you respond to that?
I think every contract we have is important, but some contracts are different and even unique. For Microsoft, our JEDI contract to support the United States military is not just an issue of commercial responsibility. It's really a question of national responsibility. And we welcome and embrace that. We sought this contract out. And one of the reasons we did is we recognized not only that cloud technology would become vital for the nation's defense, but we knew that we had the wherewithal to build a better product. It's worth keeping in mind that the procurement process for this contract, really from start to finish, was almost 2 years. And one thing that we did was put more engineers on it and focus on constantly improving our product to meet what we knew would be the Defense Department's needs. And so I look at this and I think that there's actually an interesting lesson for all of us, certainly in the world of business, but maybe in just life more broadly. First of all, never assume that you're so far ahead that you can't lose. Never conclude that you're so far behind that you can't catch up. Every day, we focus not just on catching up, but leading. And I think that when the full story is told, when people understand it, what they are going to find is that this country has dedicated people who work for the Department of Defense who focused on one thing and one thing only: buying the technology that would best protect the country.
That was Microsoft's Brad Smith. Coming up, from iPhones to EVs, how Foxconn is making a deal with Fiat to help charge up the road. That's next. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco with Sherry On in New York and Heidi Stroud-Watts in Sydney. Let's take a look at those top global tech stories of the day. Heidi.
Taylor, it could get harder for U.S. tech companies to secure foreign investments. New U.S. Treasury Department regulations will force companies that handle sensitive personal data like social media and healthcare firms to go under increased vetting for foreign investors. The rules will take effect on February 13th. Apple's main chip maker is projecting quarterly sales that are well above analyst estimates. TSMC also posted fourth quarter earnings that were better than expected. Taiwan's largest company is investing in technology to make sure it maintains its market lead over Samsung and Intel. The rollout of 5G phones this year is expected to lead to faster growth. And for the first time in more than 7 years, Morgan Stanley is recommending selling Tesla shares. According to analysts, optimism around the electric car maker's growth in China is now priced into the stock. Tesla's stock price has more than doubled since the beginning of October. And those are your top global tech stories that we're watching today. Sherry.
Heidi, thank you. Sticking with electric cars, a company that assembles Apple's iPhones is getting into the EV market. Hon Hai Precision Industry is forming a joint venture with Fiat Chrysler. It will be responsible for design, components, and supply chain management. Fiat will handle the actual assembly of the cars. Hon Hai is part of Taiwan's Foxconn technology. Joining us now here in New York is Bloomberg auto reporter Craig Trudell. Craig, so tell us a little bit about their experience, both for Hon Hai in the EV industry and for Fiat in the Chinese market.
Yeah, that question really sort of gets to the bottom of the idea that this is kind of a puzzling joint venture here, as Gabrielle Coppola, our reporter in Detroit, has on this story sort of pointed out. Hon Hai obviously has a lot of supply chain expertise in China, a lot of that with obviously lithium-ion batteries that go into iPhones and also go into electric cars. But those are two very different products, and don't just ask me, ask Apple, which everyone is familiar with the idea that they sort of flirted with going into this industry and sort of decided against it. And then you have Fiat Chrysler, which has really struggled in the U.S. market, or in the China market. They have a very small market share there. They've really struggled. It's a problem that maybe won't be solved if they're able to pull off this merger with PSA, the French car maker that itself is struggling in China. So a lot of analysts are kind of confused about what's going on here and sort of what to make about this one.
Well, and Craig, I mean, the obvious first focus on China is pretty obvious, given that we've talked a lot of times about Tesla's success in the EV market there in China. But I wonder if it's soon enough to catch up to Tesla, how they really think that they'll be successful there.
I think that's a great question. And the idea that, this is essentially two companies that are inexperienced in bringing electric vehicles to market does really sort of raise questions about whether this is sort of too little, too late. It's also worth just pointing out, too, that there are a lot of electric vehicle joint ventures in China that, we don't hear a whole lot about because they don't do a ton of volume. They're essentially pumping out compliance cars to, allow for these companies to be able to sort of, to hit the tougher emission standards that car companies are now being held to in that market.
When we think about electric vehicles in China, of course, one of the first that come to mind is Tesla and its Shanghai Gigafactory. So could this new venture pose a significant challenge to Tesla in the future?
We don't know yet what sort of volumes we're talking about here, and actually the joint venture still doesn't have a formal agreement, so we're still maybe in the early innings of finding out just how big their ambitions are. We know that Foxconn is a huge company and does serious volumes. Another sort of question that will be interesting for them to have to answer is that this is a Taiwanese company, and there are some serious issues of whether or not that will sort of, whether this is a ticket for Fiat Chrysler to be able to be eligible for subsidies. That's one of the ways in which Tesla is really able to sort of potentially succeed with this new factory that you just mentioned.
They didn't have a great day today, though, right? They were downgraded at Morgan Stanley. What's the significance of that? Yeah,
I think Taylor Riggs, she had a interview with another analyst earlier this week at JMP Securities. The idea that the stock has really sort of taken off in a serious way very quickly, and I think you heard some echoes in Morgan Stanley's analysis with what JMP had to say on Bloomberg Tech earlier this week. Just the idea that the valuation is maybe a little bit rich at this point.
Craig, we were starting to wonder who are Tesla's competitors in the EV market and specifically in China. Does this start to give us a little bit of a glimpse of some competition trying to even catch up to Tesla?
Well, it is just a sense this Fiat Chrysler, joint venture with Hon Hai. It is a sense of just how many competitors there will be. There's a real question about how many of those to take seriously, how many are going to stay, essentially compliance projects that the companies just sort of don't have a choice but to explore. But absolutely, there's going to be just a ton of competition in this. Both because of the need to hit tougher standards and just the sheer volume. You hear Honhai say in this story that they really sort of look at the opportunity in this market to do volume, and that's why they're focusing on China first, and then maybe after that they look at exporting elsewhere.
We have a ton of eco data coming out of China this evening. Are we seeing any signs of a recovery in the Chinese car market right now?
Not that I've seen, and definitely, through the year end for China, there was ongoing real challenges with the auto market. Some questions about whether the electric vehicle segment will see some relief from the fact that the government has sent a signal that they're going to sort of hold off on serious dialing back of subsidies, because that was, as we know, a really big impact in the back half of last year, where we saw just growth for quite a while, even when the broader market was slowing down. And once subsidies were dialed back, the electric vehicle market sort of joined the rest of the industry and really having some tough times.
How are the? Go ahead, Taylor.
Oh, Sherry, thank you. Craig, on the heels of talking about those subsidies, I want to ask you about pricing strategy in China, because it was interesting that Tesla was trying to cut their pricing models. They're well below some of the luxury vehicles, but they're still sort of right on par with some of the local operators there. What does this mean about pricing strategy in China now for these EVs?
Well, with Tesla, what you're seeing is a strategy of trying to get more in line with where you see the mass market. They're still a little bit higher, but I think that's okay, because you still have in Tesla a sort of premium brand that people are going to be willing to pay up for that technology and the cool factor that Elon Musk has brought to the industry. But if you're Fiat Chrysler and Honhai and just sort of entering this game and getting into building a brand and just jumping into this market now, you're probably going to have to really get to a point where you can offer these models very cheaply. That's actually where we see quite a bit of volume for the electric vehicle segment. A lot of these compliance cars have limited range and are sort of aimed for company and government fleets, and really more so about checking a box as opposed to going after the consumer.
Well, thank you to Bloomberg's Craig Trudell, and much more ahead, so stick with us. This is Bloomberg. According to Wedbush's James Hardiman, Peloton is not just a fad. Shares of the connected fitness company rose on Wednesday after Hardiman wrote that none of the lower-priced, interactive stationary bike alternatives represent a legitimate threat to its dominance in the space. So James joins us now. James, great to have you. Walk me through your bull thesis from $30 to now about $37 a share.
Yeah, so ultimately, I think long term, the way that investors are going to value this stock is based on their subscription business. And so as much as we talk about equipment sales, which are the majority of sales today, I think down the road, they're building towards a large, profitable, and ultimately sustainable subscription business. And if the valuation of other similar companies is any indication, investors are jumping all over themselves to be a part of companies like that. And so, yes, there's competition, but I think that the bigger point here is that this entire segment is poised for extended growth. And that is the result of a lot of people transitioning from an in-club or a gym experience to an at-home experience. And so I think the size of that market is going to be up substantially, and that Peloton stands the best chance of really dominating that market.
So, James, you mentioned valuation, and there has been a lot of concerns about how to value this company. Are they a hardware fitness company or a software tech company? Because that changes the valuation.
Absolutely. And I think today they're clearly some combination of both. I think if you ask the management team, they want to be valued as the latter. Look, the way that we put together our valuation is to really build it up based on a sum of parts. Right, so we're valuing their current business, which is about 80% hardware, based on a fast-growing but nonetheless hardware comps. Whereas we're valuing their subscription business at a much higher multiple, albeit not quite as high as a lot of the companies that have had sustained success on that front. Companies like obviously Netflix, people are paying a lot for. Planet Fitness in the fitness space is garnering very much a premium multiple. And then certainly if you think about these SaaS companies, the software as a subscription service companies, those companies are garnering really impressive multiples. So, on an EV to sales basis, we think about their subscription business at about 6 times and their equipment business at about 3 times. You put the two together, we get to 3.7 times their sales. That's the $37 that we're putting out there in terms of a price target.
Walk me through your analysis on the bottom line. CEO John Foley said we could be profitable, but frankly, the board doesn't think it's in the best interest to turn off that growth spigot to just turn out a profit. Are you comfortable with that?
I am. I mean, obviously, that comment rubbed some people the wrong way, but I would argue, at least in my experience, when companies transition from being, high growth, low profit or no profit in this case, companies to being lower growth, more profitable companies, they tend to get dinged in terms of the valuation. And net, the stock ends up going in the wrong direction. Given the fact that the end goal here, again, is a big, profitable, sustainable subscription business, I think everything that management is doing is with that end goal in mind. And so I think certainly over the next few years, within reason, I think if they see a trade-off where they can invest money and stimulate growth, even if they have to sacrifice margins to do it, they'll be more than willing to do so. It is worth noting, though, that at least on a gross margin level, these are very profitable businesses.
Well, then give me a little bit more of your analysis as you look to earnings February 15th or so. What's the number one key line item you'd like to see the company turn out?
Sure. I mean, subscribers is going to be the big number. So, again, so much of this is based on, what this looks like 3, 5, 10 years down the road. And so the single most important number that people are going to look at is the subscriber number, the subscriber growth number. Within that, I think the churn number is also key, right? That the number of subscribers that roll off of their subscriptions, their $39 subscriptions over the course of the quarter. And then probably a distant third is the gross margin of their subscription business, which, I don't expect a whole lot of leverage out of this year, but, over the next couple of years, as they get more and more subscribers, more and more people signed on, and you're not going to see as much investment in terms of new studios and new trainers, we should be able to leverage that line item as well.
James Hardiman, Wedbush analyst, thank you for joining us on your latest call. Now, Facebook backing away from plans to sell ads in WhatsApp. That's according to a report by Dow Jones. It's been said that WhatsApp has disbanded a team set up to find the best ways to integrate ads into the service. For more, Bloomberg Technology's Kurt Wagner joins us now. What do we know right now about WhatsApp's ad strategy?
Yeah, so WhatsApp has talked about putting ads inside of its status feature, which is similar to stories that you might be familiar with on Snapchat or Instagram or even Facebook. And that makes a lot of sense because Facebook already sells those kinds of ads and a lot of its other properties. So the thought of, looking through the stories of your WhatsApp friends and then coming across an ad doesn't seem as intrusive as other types of messaging ads. What the Wall Street Journal is reporting is that the plans have basically been abandoned. What I'm hearing is that it's more of a postponement. And so it's not necessarily that WhatsApp is never going to run ads. It's more that if they're going to do it or when they're going to do it, it's probably going to be 2021, if not later, whereas originally people thought maybe it might happen sometime this year.
Well, and frankly, they might have to, right? As your analysis points out, they paid $19 billion for this company. How do they monetize that?
Yeah, they have not made much of that money back right up until now. WhatsApp has mostly been focused on growing its user base. They do make a little bit of money by charging businesses to send messages to users, and that's kind of what they're pointing to as saying this is our key priority right now, is how can we let small businesses, especially in emerging markets, places like India or Brazil, how can we let small businesses that maybe don't have a website or don't have any other way of communicating with their customer base send messages, and then they charge on a per message basis, a cent or two per message. That is a more likely immediate business plan, I think, for WhatsApp, with the idea that ads, even though that seems almost more logical, may be coming in the future.
I'm going to put you on the spot. We're getting some analysis from our Bloomberg intelligence analyst, Jachendra Woral, who's saying that this reported retreat likely underscores regulatory pressure against app integration, though it shouldn't really affect the fundamentals. Is this further regulatory pressure against Facebook and all of their companies trying to integrate themselves?
That's an interesting point, because when you look at how Facebook would probably monetize WhatsApp, you look at the ad stack that they've built, this ad technology that right now exists inside of Facebook, but also powers Instagram and powers Facebook Messenger. Maybe there's something around using that same technology to also power ads inside WhatsApp that could be considered problematic. Again, I have no idea, but it's an interesting theory that perhaps bringing all the technology together for all these different platforms might be part of the issue.
Well, and you were talking about sort of I think of WhatsApp on a retail side. There's a business plan to this and sort of an enterprise way to look at WhatsApp as well. How does that fold into Facebook's bigger strategy?
Well, right now, Facebook is 99% advertising, and which is why I think all of us assume, and why Facebook has talked about, by the way, putting ads inside of WhatsApp. When you look at what they might be able to do there outside of ads, I think what's exciting if you're a Facebook investor is probably the idea of diversifying their business a little bit and saying, hey, we're not 100% reliant on the ad industry, but in fact, we can sell sort of more of an enterprise product to businesses. And if that works, guess what? We have Messenger over here that also has 1.5 billion users. Maybe we can figure out a business model that works for both of those.
You know, we heard from Speaker of the House, Nancy Pelosi, earlier today. She said Facebook is shameful in allowing misinformation. While I have you here, I want to get your comments on some of the more negative rhetoric that we're getting out of D.C., this just being the latest.
Yeah.
Where do they stand on their Facebook political ad policies?
Nothing has changed, unfortunately. Unfortunately being I don't have any new updates for you, but this policy is that, as you know, they're not going to fact check politicians, including in ads. And so that means that a politician could lie and pay to spread it to as many people as they want. Obviously, Nancy Pelosi has a personal reason to feel the way that she does, which is that there was a quote unquote deep fake video about her that spread on Facebook that showed her appearing to slur her speech. And so she had already been kind of personally impacted by this idea that misinformation can spread on Facebook. So I'm not entirely surprised to hear her come out with a pretty strong stance.
Well, the always smart Bloomberg's Kurt Wagner, thank you for joining us. And still ahead, Apple is teaming up with the National Basketball Association. Why the NBA chose Apple Music's playlist next. This is Bloomberg. On Thursday, Apple and the NBA announced a partnership that includes an Apple Music playlist featuring independent artists from an emerging label. The Baseline playlist will have about 40 songs with hip-hop vibes and will be refreshed weekly. For more, we're joined by Bloomberg Technology's Mark Gurman, who covers Apple for us. Mark, you have to explain this to me. What do Apple and the NBA get from this partnership?
Yeah, and when I heard about this, things started going, my hair caught on fire because this is the most exciting thing for me in a long time, Apple and the NBA. But essentially what it is it's a playlist that the NBA is going to use to sort of curate the song selection they have on social media. Let's say you're watching your favorite series of LeBron James highlights from last night, even though they lost, you'll get something from this Apple Music playlist playing in the background. It's also going to be one of the many playlists available in the Apple Music app. Now, for Apple, this puts them more upfront with what's going on culturally with music. Music's become a really big part of the NBA, and they're always looking to push the envelope with Apple Music. For the NBA, it's giving them more eyeballs. They have their brand right there in the Apple Music app with 60 million subscribers. What I think some people don't know is that, viewership of the NBA, your regular Tuesday or Wednesday, Minnesota Timberwolves versus Portland Trail Blazers game, not to insult anyone, is not getting as many viewers as it once did.
Oh, Mark, your analogies today are very, very funny. On a more serious note, is Apple really serious about trying to get perhaps NBA fans to really go over to Apple Music?
Absolutely. The NBA, despite viewership counts going down, is one of the most viewed sports platforms and associations across the whole world. The NBA is massive, not only in the United States, but It is the biggest deal of deals in China and parts of Europe right now. So, that collaboration could spur people who, watch the NBA away from Spotify towards Apple Music, right? They want that playlist that's going to be curated by Apple, but also promoted by the NBA. And I think the cool thing is going to be is when we start seeing players in the NBA like Damian Lillard of the Blazers and others who are not only basketball players but do lots of off-the-court stuff like making music will start appearing on that playlist down the road. And that's going to be really when you see that collaboration and really the most interesting parts really, hitting in sync.
Well, and where does this sort of fit into their broader strategy? You were noting that they trail Spotify in terms of subscriptions for music. Is this also part of a extended push to try to catch up to Spotify in some sense?
I think anything Apple really does to add to Apple Music is almost single-handedly about trying to gain that market share lead, in addition to try to make the experience better. But the two go hand in hand, obviously. So I think every additional partnership can't hurt, right? Apple adds an NBA partnership. That's not going to insult anyone to unsubscribe, but it can potentially gain a few new subscribers for them, which is very important for their long-term growth in the services segment.
Bloomberg's Mark Gurman, thank you as always for joining us. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.